Our next guest thinks this may mean investors are coming around to the idea that we could be facing a bubble that's about to pop. Joining us now is Rosenberg Research founder and president, David Rosenberg. I don't know, David, you've been saying it for a while, and you would have missed the big run-up that we've seen so far this year in the NASDAQ.
All right. Yeah, absolutely. We all know the story with the NASDAQ and the story with the stock market that if you're an index investor and willing to take on that concentration risk, you missed out on a huge rally. But what's interesting is that nobody talks about what happened last year in the context of the big spike you've had in these names after what was a real meat grinder in 2022. Big picture is this, Sarah, is that the S&P 500, through all the peaks and valleys, is at the same level today that it was 2 years ago. So you've really had 2 years of nothing in the broad market, even with the big rally this year. You've had nothing for 2 years except for intense volatility.
But that can be, that's very positive, isn't it, given that rates have risen so much over that period?
Well, why is that positive? Because rates have risen. What it's telling you...
It's resilient.
It's telling you that it could be resilient, but so what? You haven't made money in the stock market outside of the dividend in 2 years. And then you have to do the math. Like, are you a momentum chaser, or do you respect valuations? 2 years ago, when the S&P was at this level, real interest rates were negative 170 basis points. Today, real rates are 150 basis points with pretty well the same valuation. So the answer to your question before, if you don't want to call it a bubble, I'm not going to say, there's parts of the market that are in a bubble, but are you going to tell me that a 19 forward multiple on the S&P 500, which is a 5.2% earnings yield, is what you'd want to buy, Sarah, when you pick up a treasury bill at a premium to that? So I would say that sometimes, I guess, being of a rational mind can impede your performance over a few months. But you're actually getting paid not to be in the broad indices right now. When you look at where relative interest rates are, risk-free rates, and of course what you get in the corporate bond market, and a more superior part of the capital structure.
I wonder, though, David, how you're considering sentiment and positioning here. There's a bunch of managers who are way behind. The year's more than half over. Isn't it likely that if they get any chance, any dip, they are going to snap it up?
Could well be. The question is, what sort of dip are we going to get? And then the question is, and it comes back to my response to Sarah, do you or do you not respect valuations? So at any moment in time, Carl, yeah, we can talk about fund flows and talk about market positioning and sentiment. But in the final analysis, what are you willing to pay as an investor for the future expected earnings stream? And how do you benchmark that against alternatives? Because what the Fed has done these past, say, 12 to 18 months is they've taken the N out of TINA. So there is an alternative. So I know that, you'll sit there and say, oh, well, you missed out this big rally in the stock market. But there are alternatives out there that actually offer superior characteristics on risk-adjusted returns. So, I'll get the comment back from you folks, well, look at the gross nominal returns, but you have to adjust for the risk. And the major point I'm making is that no matter about buying the dip in the stock market or not, the alternatives out there in the fixed income space, it's a cornucopia that has not been here for years. And so I would say that you might want to shift your attention myopically from the stock market to what the credit markets are offering you right now.